Good evening, everyone, and welcome to this team's first AskNXpert session. While this is right at the time of tax audit, this brings an excellent value addition from KSCAA side because here is a time when we can directly ask the questions and get answers from from our expert three panels. I am joined today with the three eminent panelists. One is CA Badrinath, who will be taking care of GST-related queries. CA Shiv Shankar, replacing CA Ravi Prasad sir for the company law matters and accounts. And CA Naveen Khariwal, who will take the matters on income tax. The three eminent panelists don't require introduction, while I only require introduction. So I'm cutting short on all the three formal introduction. I'm going to the session directly. The first question which I would start probably is an opening session with CA Badrinath, which is on the point of GST enforcement. And we are seeing more and often times when the GST enforcement happens in the time or in the probably in the matter of buying piece, there will be a lot of declarations which will be made. So two circumstances arises, sir, or one contingent issue which remains is on the valuation of inventory. What happens when there is excess stock found physically vis-a-vis books? And what if there is a less stock which is found vis-a-vis books? What are the points from the GST Act and law point?
So I'll thank you very much, Pramod, to start with. Thanks for this opportunity. It's really a pleasure to be interacting with all of you. I'm audible, right, Pramod? It's fine?
Yes, yeah.
Thank you. So an interesting one. If there is a excess, rather, let me take the easier one first. If there is a inventory that is short when compared to what is in the books of accounts, then the deeming the deeming friction that comes into play would be that the stock has either, it is damaged, destroyed, whatever. It is not in existence. So the equivalent amount of ITC will have to be reversed, 17.5. 17.5. That is if there is a shortage of stock when compared to what is the stock as per the books of accounts. On the contrary, if there is an excess stock, then quite possibly the natural fallout or natural inference would be that certain purchases have not been recorded or certain sales have not been recorded. Then there will be a deep dive into the inventory records to see what is where the missing link is. Why is there a difference? Then the question of reconciling with your e-way bills and invoices and vendor accounts and customer accounts will all begin. As long as it is small, okay, let me add this flavor as well. If it is goods which have an influence, the weight or the quantity, normally the weight has in the weather, the climatic conditions have an influence, then that also plays an important role. 1. 2, if the quantity in which the purchases were versus the quantity in which it is recorded in the books of accounts are verified. Suppose I buy it in tons, I buy it in numbers, but subsequently I measure or I keep a measure of that in kilos. Then these aspects also play a role in terms of whether the excess or short is because of an accounting issue or because of other natural reasons. So accordingly, there'll be a question, there'll be rather a few questions raised. At the cost of repetition, shortage is easier. Only input tax credit will be asked to be reversed unless there is a suspicion for a deep dive into the transactions. But if there is an excess, the natural fallout, next step will be a deep dive.
So how do they incorporate all of this in the returns or in the annual returns while finalizing?
How do you incorporate that into which returns? We are talking income tax returns or the financials? The
financials are complex. I mean, is there something which they have to do at GST level?
GST nothing specifically, except where if it's a shortage, I declare that under 17.5 and reverse the ITC.
Okay. So
as a permanent reversal of ITC.
Okay, fine, sir. So I'll go this same question. I will take it from the account point of view, sir. Shiv Shankar, sir, how is that you will show it in the books of account? Now, there are two circumstances. One, where it is a private limited company where CARO is applicable, and the circumstances when CARO is not applicable. So, I mean, what is that as an auditor? We should be careful when such enforcement happen and somebody has already, given some statements. Yeah.
Yeah. So whether CARA happens or not, so the auditing standards we need to follow with respect to assuming it is a case of fraud. Okay, so it is either it is committed by the management or employees or some third persons. Okay, so we will take a first instance of shortage. See, I am showing 50 lakh rupees worth of stock, but physically it is there only 25 lakhs. So whether adjustment required to be made in the books of accounts? Yes, required to be made in the books of accounts. So to that extent, there will be charged on the profit and loss account to the extent of 25 lakh rupees, and your profit will reduce to that extent. And you take a balance figure only you to balance sheet. That is with respect to accounting point of view is concerned. So then comes to the auditor responsibility. So we need to check. So it is on account of error, omission, commission, fraud. Okay, so all these things, if it is an error, so then we can rectify. So it is a omission, so then also we can say, so it will happen. But it is a commission, so somebody has committed, so intentionally. Then we need to see whether that kind of amount, whatever involved, with respect to my whole profit and loss account or balance sheet. So I can say that sometimes that fraud, whatever it is committed, in P&L there will be significant difference, but when it comes to the balance sheet, so much difference is not there. Assuming I will just give an example, one 10 crore rupees purchase, unaccounted purchase is made, and 10 crore 5 lakh rupees sales is been made. So with the P&L wise, it shows a big figure. As far as balance sheet is concerned, so net impact on the whole balance sheet is only 5 lakh rupees. Assuming I have paid all creditors, everything it is paid. So then I, as a auditor, first of all, I should say whether proper books of accounts are maintained. So if some of the entries not recorded, purchase or sales are not recorded, how do we address as per section 143(2)? And then when it comes to whether books of accounts or financial statements will give a true and fair view of the affairs. So it is once again based on case to case basis, what is the level at which it has been there. So there is, whenever you find this kind of things, then you report to the persons who charge with the governance. So either audit committee or board member, if they are also involved in this case, so then we might see whether it is a fraud case. If it is a fraud case, as per ADT 4 has to be filed. If it is more than 1 crore rupees, amount involved is more than 1 crore rupees, you need to file ADT 4. If it is less than 1 crore rupees, then there is a procedure is given. So you need to report to auditor, so board, and they have told you need to give 145 days time to them, so to come back with the replay. And in the board's report, they have to make a disclosure with respect to so much of fraud and other things have happened. So these are the related portions of any fraud or on account of, it is basically fraud. I will say purchase and sales overstatement, and it is considered as a fraud unless it is a omission or commission.
So only if it is materially get recorded. I mean, how is that? What is the disclosure, sir? You only talked about reporting. Disclosure.
Yeah, so disclosure with respect to auditor. So we can say that. So if it is ultimately, if you see that if it is not giving true and fair view of the financial statements on account of fraud, because earlier I was showing as a profit. Now after adjustment of this entry, it becomes loss. And number two, as per SA for 250, we need to consider all the other laws of the which is applicable to the company. It is not only Companies Act. We need to look at all the other laws which is applicable to the company. As per 139, so it is even auditing standards are mandatory now. Earlier, before 2013, so we used to say auditing standard is not mandatory, it is only for auditors, not for the clients. So now auditing standard given a same kind of footing with respect to accounting standards. So as an auditor, I need to follow auditing standard. Auditing standard says you have to consider all the applicable laws and you have to see the materiality and whether you want to give adverse opinion or disclaimer or qualified opinion based on SA 2705. They have given the stages where they are not giving the information. So I know that there is a fraud, but they have to give me information to report. If they are not giving, so then I can give a disclaimer.
Fine, sir. Okay. So, Naveen, sir, now with the same issue, how do we show it in tax audit? So the one argument was the deficit in stock, can it be shown as unaccounted sales and be taxed under section 115 BBE?
Yeah, interesting scenarios. Let me consider the excess stock first as such. So, my dear friends, in case there is a survey or there is a search, there can be two scenarios. One will be the excess stock and one may be the deficit stock. As I have been discussed, or light is thrown by both my speakers, co-speakers rather. So if there is excess stock, what is to be done? Take in case of a survey, excess stock is found. We'll take a case of a jewelry concern. For example, 2 kgs is the stock physically found, 2 kgs. In the books, it is 1 kg. Therefore, excess stock is found to the extent of 1 kg, basically. Today's market rate is around about, say, 70 lakhs for pure gold. So now the department will tell, I'm going to take this and tax it under section 69 as unexplained investments, read with 115 BBE. And that would be 60% rate of tax plus surcharge plus cess around about 78%. I'll also levy a penalty at 10% on 271 EAC. Now the moot question is how we as a consultant or a chartered accountant or advocate would have to argue the case. Main thing is now I have accepted that 70 lakhs, there is excess stock. Absolutely no problem between me and department. The bone of contention between me and department is the rate of tax. Because as per department is abysmally, substantially high at 60%. I am telling it is business income. Now, why it is business income? I have got a plethora of high court judgments. Kindly do not worry. Argue on the same line. Inform the assessee to happily, give a declaration. Only thing you should tell is it should always business income, business income, business income. The assessee should not give a statement or sign the paper or, tell an answer that it is other sources or 68, 69. First point is to be educated that please always tell it is my business income only. Why? Now, I am not able to distinguish the stock or item. When the goods are found 1 kg extra in my godown or in my shop, I am not able to distinguish whether this jewelry or this ring or this item is declared or not declared. I am not able to distinguish. Point number 1. These are all the, I am not going to judgments per se. These are all the, judgments delivered by the courts and tribunals. So one court is telling, for example, are you able to distinguish? Is the assessing officer able to distinguish or separately identify the inventory? No, not possible. Fine. Therefore, it is a suppressed income emanating. The excess stock is emanating out of the suppressed income over a period of time. I have to declare before the department, yes, sir, it is my suppressed income emanating. This stock is generated out of the suppressed income emanating over a period of time. Therefore, it is my business income. And you have even the recently, apart from 5-6 High Court judgments, you have the recently delivered judgment by Bangalore Tribunal in the case of Ramchandra Shetty and Sons, 2024 judgment, 163 taxman.com, 666, Bangalore Tribunal, Chandra Pujari, accountant member, and Keshav Dubey, judicial member. Clearly, it says there is a survey in the case of the SSC and excess stock is found. So, what is it the tribunal is telling? Para 10.20, the tribunal is telling, therefore, in the present case, where the source of investment or expenditures clearly identifiable and alleged undisclosed asset has no independent existence of its own, or there is a separate physical identity of such investment or expenditure, then first, what is to be taxed is the undisclosed business receipt. Undisclosed business receipt, okay, which is invested in unidentifiable, unaccounted asset, which is my jewelry. And only on failure can it be considered to be taxed under section 69. So there are judgments, so do not worry. Apart from that, also it is held in the following judgments. Income surrendered by assessee during search or survey. Same principle even for such excess stock from business operations. I have surrendered as excess stock from business operation. Same could not be brought to tax under section 69. If excess stock was found relatable to business, then and no other undisclosed source is proved by the department, such income is assessable only under regular provisions and not under 115 BBE. Take a reverse scenario if there is deficit stock. If there is deficit stock, what will you do? Now, for example, GST, they are telling, they will come and tell, there is a deficit stock, 1 kg deficit stock again. For example, 70 lakhs, they told is on unaccounted sales. DRC3 made me pay. I paid penalty 3% plus 3% in case of jewelry business. 3% plus 3%, 6% I paid. DRC3. Now it is undisclosed sales. How to pass an entry? You have to be very careful, my dear friends. Either 70 lakhs, I'll have to increase in my sales account, increase cash. On that day, this has to be done. Not at the time of audit. I repeat again, on the date of a GST survey example or income tax survey, on the date, you are going to tell, for example, if 1 kg deficit stock is there now. Deficit stock, nothing but my unaccounted sales. Therefore, on that day itself, you have to cooperate with the department. Sir, this is a sales outside books. I'm bringing into books, cash sales, cash bill, etc. See to it 269 ST is not attracted. Each bill to be less than 2 lakhs first. 269 ST should not be attracted. I'm going to cooperate with the department, pay the tax. Careful entry, 70 lakhs, increase sales, 70 lakhs, increase cash balance. Or receipt from debtors or better cash balance. Secondly, 269 ST, please take care. Thirdly, what is to be taxed? Plethora of judgments is there. Is only the net profit element or gross profit element. And you cannot tax my entire undisclosed sales or unaccounted turnover. What about your next year 3CD and 3CB? In your 3CB, you will have to inform in your audit report itself, there was a survey, there was a search, etc. And this was the declaration. That is all. Do not tamper with any other 44 clauses of 3CD because I would be inviting penal action on the SSC as well as on myself. Because I am not going to tell that, there's a violation of 40A3. I cannot tell there's a violation of 269 ST. I am not going to tell there's a violation of 269 SS or 269T, etc. Therefore, I will only qualify the report to the extent in 3CB saying that there is a search and a survey. This is the declaration, and this declaration is the form of income from business and not other sources, etc. And I would like to pay the tax in 3 installments of advance tax, etc., etc. Accordingly, how my friends have explained the GST impact as well as the accounting entries. Thank you very much.
Fine, sir. Thank you, sir. So the next question is to Shiv Shankar, sir. One is the Karnataka, there is a recently notification of the rules which was notified, which is on the compulsory gratuity and insurance, which was notified on 10th January. So what if the company does not comply with it? How do you take this into consideration? One if it is a company, private limited company, one if it is not a private limited company, I mean, under both the circumstances.
No. So as far as I already told, so consideration of other laws which is applicable to the entity, which we need to consider. Once again, we need to go by materiality with respect to assuming gratuity trust is not formed. Okay, so gratuity trust is not formed, but you have already created the liability or provision as per the accounting standard 15. So based on actuarial basis. If that being the case, so financial statement as far as measurement and liability crystallization, everything you have done. Only the procedural mistake of not creating a trust and transferring your corpus, because even that notification does not say that you have to entire liability has to be transferred to the trust. What it requires only to create the trust. Okay, I might create the trust and I can transfer my liability to the extent of 5% or 10%. So to that extent, according to me, so it is not any material, laws we have violated. Yes, we have violated. Then we have to consider, assuming I am a, employee-based company like software company. Okay, whereas I am a company where I am a trader. My turnover is basically purchase and sales where no employee movement or employee cost is very minimal, or where I'm employee based company or software company where employee cost is a bigger one. So I need to see once again materiality and take into consideration. According to me, so if you have not created trust, but you already created the provision as per accounting standard 15, you need not report anything in the financial state audit report.
Okay. Sir, now the other question is NAFRA applicable even to tax audits?
NAFRA is applicable only for listed companies. Unlisted public companies having turnover of more than 1,000 crores or paid up capital more than 500 crores or loan more than 500 crores. But other companies with the central government, they can notify with the public interest. For that only it is applicable. Otherwise, per se, straight away, it is not applicable. It is only for unlisted public companies and listed companies. Unlisted public companies, 3 conditions. But central government, they can bring it at any point of time.
Okay. Badri sir, the next question was on startup. A startup has been paying expenses out of the grant which is received from the government. Can they avail the ITC? Can the startup claim the ITC on such of these expenses?
All right. See, there are two aspects in this. If I have to look at it in a little more, say, one level down. One is the output, the other is the input piece. One is whether I've received the grant or no is secondary as far as, I mean, grant has no connection with the ITC as such in the very first sentence, if I have to tell you. What is the startup into the business of? What is it doing? And what are the costs incurred? The source for paying out those costs takes a backseat. First is, what is the business that the startup is in? Let's say it is, the Bangalore's very popular, what Bangalore is known for. Let's say it is in one of the ITs, fintech or edtech startups. So what is that is a taxable activity as far as GST is concerned. So as and when there is a service that comes out of my business, that will be either liable to GST or it will be zero rated, I'll claim it as exports, etc. So the corresponding costs that go into that aspect of the service is most certainly eligible for ITC. How I incur the cost is second. Now that as long as it is related to an output, which is a taxable activity, certainly we will be eligible for input tax credit. Yes, of course, I should have all the other conditions fulfilled. Not to kind of discourage people on this, but there are 18 plus 6, 24 conditions to be fulfilled to be able to take input tax credit under GST. Some of them, as we can kind of recollect off the envelope, are, you should have an invoice, you should have received it, you should have paid within 180 days, it should have appeared in your 2A, 2B, you should have filed a return, all that stuff. Now, grant is received from who? One of these charitable institutes or charitable organizations or NGOs or government. That itself can be taxable in certain circumstances. Okay, if there is an obligation underlying that grant, right, it can become taxable. The 54th Council kind of reiterates this and stresses on the fact. The discussion in the 54th Council has been that if the grants are of ABC category, then they are wholly exempt, not liable to GST. So anything other than that can become taxable. So in this case, if we are establishing a link between the money received as a grant and that is what is incurred for the purpose of the costs, then there is a direct link between a taxable activity and the cost that is incurred. That makes it even more stronger to be able to claim the ITC.
Okay, fine, sir. Naveen sir, now we'll go to the next question, which is on MSME. I think time and again we have spoken on this point. It has become a national issue. Wherever we go, people ask this question to the experts and to the finance minister. I mean, all are asked the same question. So yes, on that point, the question was, even the payment due for the purchase of capital goods, purchase of goods are covered under this section. Can you please throw some light on which category of purchases are covered and which are not covered under 43 BH?
Yeah. So if you see in this budget, all were, including myself, we were all super confident, overconfident. Madam would make an amendment that, she would not be, leaving this provision in the act, or she would at least defer. But none of it happened, and the budget was totally silent on 43 BH. Therefore, it has become very much applicable, and it has become inevitable for us to report now. Most important is we are standing today, 13, 14, 15 September, just 15 days for audit now. How do you go about it? My dear friends, I have got 3 scenarios. How to report? Please see which scenario is applicable. Accordingly, please make it a report. I'll share this with Mr. Pramod also. And in fact, Mr. Pramod was telling at the time of introduction, these 3 speakers need no introduction, only I need introduction. So in my opinion, even he does not need introduction because he is our past chairman also. Anyway, coming back to the MSME, I'll give you 3 scenarios. I'll share with Mr. Pramod also, don't worry. These 3 scenarios, you can see which scenario applies to your client. Accordingly, my humble request is, please fill up this with regard to 22A and B. Clause 22, disclosure is required. So that disclosure will appear in para 3, para 5 of 3C and 3CB. Do not worry, in that 17 observations. Plus clause 22 observation. Now, scenario 1. What is the heading? verification on test check basis and based on representation received from client regarding MSC classification. That means the auditor has done a test check basis, and that too it is based on representation received from the client. That is scenario 1. What is scenario 2? 100% verification done. That is also based on auditee's MSME classification. Although it is MSME, it's only micro and small, medium is not included. So 100% verified, however, based on auditee's MSME classification and management representation. You have to be very careful. Point number 3, scenario 3, absence of necessary records itself, hence unable to verify 43B clause H. This may be little harsh, but in the terms of the scenario, I am not able to help myself because I'll have to help myself and then the client. So there are 3 scenarios. First one is verification on test check basis. How to go about it? In the course of our audit, for the purpose of verifying disallowances under section 43BH, as per clause 22, we have conducted verification on test check basis. Underline, we have conducted verification on test check basis. Next, we have relied on MSME classification provided by the auditee and representations made by the management. Again, we have not independently verified the accuracy of the MSME classification. Consequently, our verification of the compliance with section 43BH is based on the information and representation provided by the auditee's management, and our opinion is formed based on the selected samples because it test checked. Selected samples received. Last 2 lines. Our opinion is thus dependent on the correctness of these classification, representation, and the adequacy of the sample size. Due to these limitations, the amount of disallowance mentioned in clause 22 may not be accurate or complete. This will take care. Absolutely nobody can, question me. Scenario 2, 100% verified. But what? I am not verified. Based on the auditor's MSME classification and management representation. Again, same para, 3 lines. In the course of our audit, for the purpose of verifying disallowances under 43BH, as per clause 22, we have relied on MSME classification provided by the auditee and the representations made by the management. We have not independently verified the accuracy of MSME classification. This is very important, sir. Please take the MRL. Please note down all this. Of late, there was a judgment yesterday or day before yesterday, I think. The department has taken a chartered accountant to court. I'm yet to read that citation. I just went through, I think I was able to go through today morning. What are they telling? The chartered accountant has not signed the annexure to reports. Chartered accountant has not signed the annexures to the various tax audit reports. And department is telling it's hauled him for negligence and they have gone to the High Court. High Court has set aside the matter. I am yet to get a copy of the judgment now. See, the department is also now training its guns on the chartered accountant like this. Now, anyway, scenario 2, we have relied on MSME classification provided by the auditee and representations made by management. We have not independently verified the accuracy of MSME classification. Then, consequently, our verification of the compliance with 43BH is based on the information and representation provided by the auditee's management. Then last line, our opinion is just dependent on the correctness of these classifications and representations. So we cannot verify, sir. I took a certificate. He classified this is micro, this is small, this is medium, etc. Ultimately, what I have to do? I'll have to go very, very simple, sir. MSME, there is nothing Greek and Latin there. I just need to find out, are you guys micro or are you guys small? If you are micro or small, next question comes, sir. What has happened? Have you made the payment as per section 15 of the Act? Acts under section 15 of the MSME Act. 15 days or 45 days. If you guys have not made the payment, in my Income Tax Act 43B clause H after A, B, C, D, E, F, G, H, they are telling, please disallow it disallow it, that's all. The proviso is not there for 43B, for the A to G, whatever proviso is there, that proviso is not there for H. Therefore, even if you want to make payment up to due date of filing return, I am sorry, deduction will not be allowed. Only it will be allowed in the year of payment. The last one, scenario 3, absence of necessary records, hence unable to verify under 43B clause H. In the course of our audit, we have noted that the auditee does not maintain complete records necessary to verify the disallowances under section 43BH. Consequently, we are unable to determine whether all the amounts claimed under this section have been correctly accounted for and duly paid within the specified time frames. Last 2 lines. This limitation restricts our ability to verify the completeness and accuracy of the compliance with section 43BH and thereby reporting in clause 22. As such, our report is qualified to this extent. That last line I leave it to you. You want to write, you can write, or it may be a bit harsh also. As such, our report is qualified to this extent. Otherwise, you can leave that line, and this will safeguard you, yourself, as well as your client. Thank you, sir.
Yes, sir. Someone is asking the source also, sir. I mean, Ranganath Shina, in case you want to answer it in the chat box.
Yeah.
Shiv Shankar, sir, the next question is on the current year's amendment, which is regarding the audit trail. So two amendments are there, which is the audit trail for private limited companies. And the second one is on the financial statements need to be followed. I mean, there's a guidance note for non-corporate entities also, financial statement to guide. So the first question was, what is books of accounts and where all the audit trails need to be maintained? And if it is not maintained, what are the disclosures which needs to be given by the auditors? To what extent the audit trails, I mean, have to be maintained? So few people are arguing that even the TDS softwares which they maintain should have a report. Some of them are saying, and the payroll software should have audit trails. So can you throw some light on that point?
See, what is audit trail, what we are talking about? So audit trail is something whenever you make any changes, or when you make entry, or when you delete, modify, alter, or make the entry, there should be trail. So number one is the time. Number two, if it is possible, the person who has done with the login IDs and other things. Okay, so that is what we are talking about audit trail. So it is more of to identify, so any mischief is done at the closure of audit, or it is a normal course or anything. See, what they are asking is only audit trail. So it is not that we need to go and check. So whether the audit software what they are using is having the audit trail. Okay, if it is there, you say yes. If it is not there, you say no. So it is better to say no instead of you say yes and then you will get caught. So because audit trail, you definitely somebody can go after 2 years and 3 years and check whether audit trail is there or not.
So, but what is books of accounts, sir? I mean, so
yeah, so books of accounts, once again, see, there is two things. One is books of accounts, one is maintaining the audit trail for that books of accounts. Okay, so books of accounts still you are maintaining. It is not that you are not maintaining. See, I have paid some money to some vendor on 1st April, but I have made the entry on 3rd April. Does not matter. Even I have written the whole books on particular day, one particular day. So does not matter. So it is not to check when you make the entry or so deleted modification. Only thing is whether you have audit trail. If audit trail is there, you say yes. If it is not there, so that software, whatever is using, does not having audit trail. So there is a specific para in the audit report. You mention very clearly saying that whatever the software they are using, it does not contain the audit trail. Nothing will happen to client as well as the auditors. It is better to, this is a factual reporting. There is no opinion involved. Okay, so where we can take some leeway on opinion. So with respect to this is fact finding, it has to be accurately given. So if it is there, it is there. It is not there, it is not there. So you asked me second question.
Second question is on the guidance note which has come for non-core financials for preparation for non-core.
It is there for last year also. It was there last almost I think 2022. I think it has come. So but this year it has taken more traction.
Because it was a technical guide, then now it has come to guidance note is what.
Yes, now it has come as a guidance note. See, even that guidance note, what they are trying to do, they are replicating the Companies Act disclosures and other things. Number one, they are asking previous year figures. For partnership firms, we never used to give the previous year figures. Okay, so now we need to give the previous year figures, and almost all the disclosures of more or less Companies Act disclosures has been brought in. So this guidance note is not applicable to NPOs because there is a other guidance note which is already existing for NPOs. Okay, but it is applicable for all the entities other than companies because it is a guidance note. Once again, guidance note is a recommendatory to the members to follow. Though it is recommendatory, we should have a strong reason why we should not follow. If you are not following, you should have a strong reason why there is a disagreement with respect to them. So in my opinion, it is better to follow. So if ultimately what is everybody's apprehension, so they will see last year GP, this year turnover, so all this thing. If they want to see, let them see. If they want to do that exercise, they can always call for last year financials and they can verify. So there is no need for us to, over protect any client or something like that. So it is better to give and follow that guidance note. That is what is my opinion.
Yeah. Badri sir, the next question is on the holding and subsidiary company.
All right.
I'll read the question, sir. If an invoice is raised by the holding company for management services, the RCM shall be paid.
Sorry, just say that again.
If an invoice is raised by the holding company for management services, RCM shall be paid. The holding company does not intend to raise an invoice for this, as a subsidiary is only providing services to the holding company and billing at cost plus margin basis. Should the holding company be advised to raise invoice for management services to avoid the RCM for non-compliance?
Okay. I assume that this is an international transaction we're talking, because otherwise it is forward charge mechanism. There is no reverse charge that will be applicable on this transaction at all. What I assume in this transaction is the holding company is outside India and the subsidiary is what is in India. There is a cross charge that is happening for the management cost from overseas to India. Yes, if there is a cross charge, it is liable to GST. Transaction value, as in the invoice value, will be taken as the GST value. There will be no questions asked as far as why is it that, why is it not, why is it only this amount, why is it not higher, why is it not lower? No questions asked. Okay. Having said that, if there is no cross charge that has happened for the past years, then also no questions asked, because as far as the international transactions are concerned, as long as it is a cross charge kind of a cost between related group entities, subject to the condition that the recipient in India is eligible for full ITC. Okay, the subsidiary company in India is eligible for full ITC, then there is a what do you say? There is a leeway, there is a concession that is granted to say zero is accepted. There need not be a cross charge ever for this at all. 211. Sorry, not 211. What am I talking? 211. 210. It's circular 210 and 211 of July 2024. 210 talks about international transaction which has a cross charge. 211 talks about timing of the credit in respect of RCM transactions. If I superimpose both, then if there is a cross charge that has happened in the financials, then GST of 18% is payable on that amount. If there is no cross charge, there is no GST, no questions asked. And as far as input tax is concerned, the circular also clarifies, 210, 211 read together, clarifies that the eligibility to take the credit triggers when I am in possession of an invoice that is prescribed under 31(3)(f). Rule 31(3). What is that? In respect of a reverse charge transaction, then the invoice is not the invoice issued by the supplier, but it is the self-invoice that you and I as recipients raise. Okay, I'm sure all of us will be familiar with the self-invoice. In all RCM transactions, it is not only the invoice which my supplier gives, but as a recipient, I should also raise another document as far as GST is concerned. It is part of my GST records. That is what triggers, that is what enables me, that is what entitles me to take the credit. So even if the transaction relates to way back 18, 19, 19, 20, etc., if I am raising a self-invoice today for that transaction, then I become entitled to take credit today and it cannot be disallowed. So this has a small history. I just take a minute or two on this, Pramod. We all of us are familiar, rather many of us will be familiar with the ruling of the Supreme Court in Northern Operating Systems. What happened in Northern Operating Systems was there were people who were deputed from Northern Operating Systems US into India. So the argument was that that is a pure salary payment. It is not liable to service tax those days, and the similar analogy as far as GST is concerned. So this Northern Operating Systems ruling is not a GST ruling, it's a service tax ruling, where they said, look, primary employment is what prevails, that is not discontinued. Therefore, that is what is given importance. Therefore, it is not simple reimbursement or payment of salary by India, though that amount gets disclosed in, as income, as salary expenditure, there is a 26, there is a Form 16 given, etc., etc. It is liable to service tax in summary and substance is what Supreme Court said. So applying the same thing, what happened from 17 till 23, the year in which the ruling came, all the deputations became liable to GST. Means what? Again, 16.4 has section 16.4 of the GST Act has a time limit which says I should claim the credit within September of the following year. Earlier it was September return, which is 20th October, and now 30th November. Okay. I have not claimed for 17, 18, 19, 20, 21. I have not. So what happens to the tax that I pay? It is in that direction to say that, look, for whatever reasons, if there is a tax liability that has already got discharged on an earlier date, though it is though there was a delay in payment of tax, as long as I'm raising a self-invoice today is the day I should reckon for me to take the credit. That is in sum and substance. Did I clarify, Pramod?
I'm sure the person who asked the question, sir, I'm not the one.
Okay.
I'm just reading out somebody's questions.
Sure.
Yeah. Sir, Naveen sir, before Naveen sir goes away and then handles again some more tax audit, I think I need to catch, sir.
Yes, sir.
One is, sir, do charitable trust having commercial receipt of more than 10 crores, whether are they 44 AB is applicable and what's the due date? One.
Now, what has happened, and if you see here, there are two sections, 11.4 and 11.4A. What is 11.4 telling? Property held under trust includes a business undertaking. And where a claim is made that the income of any such undertaking shall not be included in the total income of the person in receipt thereof, then the assessing officer will determine the income of such undertaking in accordance with the provisions of the Act relating to assessment. That is. And what is 11.4A? 11.4A is telling, the business, you can carry on a business, the trust can carry on a business, but only such business which is incidental to the attainment of the objectives of the trust. And then it is telling you should also maintain separate books of account. Now, another provision is 12A1B. What is 12A1B telling? When I come to 12A1B, what is it telling? Where the total income of the trust or institution computed without giving effect to provisions of 11 and 12 is more than the taxable limit. That means more than 2,50,000. Then 1 and 2. 1 is what? Books of account, other documents have been kept and maintained in such form and manner. You know that. That is given in Rule 17A. 2 is telling accounts of the trust or institution for that year have been audited by an accountant defined in explanation below subsection 2 of 288. That means your chartered accountant, etc. Before the specified date referred to in 44AB. That's all it says. And the person in receipt of income furnishes by that date the report of such audit in the prescribed form, duly signed and verified. That is all it says. Nowhere it is talking about the limits. If you see, and then again, if I come here, it is held in this Delhi ITAT judgment of United Educational Society, 107taxman.com, 127, wherein what the tribunal is telling, provisions of chapter 4D, that is section 28 to 44D, are applicable while computing income of business or profession, and these provisions are not applicable in respect of charitable institutions whose income is computed under section 11 to 12. Similarly, it is also held by in one more judgment of Tribunal Mumbai, CIT versus Magnum Fund, wherein it is held that provisions of 44AB cannot and do not have any application in relation to incomes enumerated in chapter 3 and are expressly excluded from such total income. So therefore, if you see, the end result, if you see, what we can, now incidental business under 11.4A, what is it telling? Tanti Trust, you take Supreme Court judgment, what is it telling? Supreme Court is telling that business whose total income is utilized for the purposes of achieving the objects of the trust should be considered as incidental to the attainment of the object. Similarly, one more Supreme Court judgment is there. It was a Madras High Court, Jania Kammal, Ayandar Trust. Clearly, the Supreme Court ruling, earlier Supreme Court ruling was reaffirmed, 277 IDR 274, where the seemingly unrelated business of manufacturing paper cap was held to be incidental as the entire income was applied for charitable purpose. Now, incidental business will not fall under the scope of business. So Supreme Court has held in case of Yogiraj Charity, incidental business activity would also be treated as charitable activity if it is necessary and incidental to the primary activity. In the Institute of Chartered Accountants of India, this case rendered on 4th of July 2013, while considering the activities of ICAI, it fell within the proviso to 2 in bracket 15 as introduced with effect from 1st April 2009. This court, after considering the Supreme Court decision in the case of CIT versus CST versus Sai Publication Fund, it held that if the dominant activity of the assessee was not business, then any incidental or ancillary activity would also not fall within the definition of business. Therefore, incidental business activity to feed charity cannot be classified as a business, and therefore the income from such incidental like business activity is to be computed in a commercial sense as per the normal scheme of taxation as applicable to a charitable trust, and the provisions to compute income under the profits and gains of business and profession will not apply. So therefore, if you see, tax audit is a specific requirement only for those assessees having income under their business and profession. Therefore, there would be no obligation on the charitable institutions to get the accounts audited under 44 AB. However, if you are held proviso to 215 applies and you are telling that no, there is a violation and therefore you are carrying on a business, and therefore if the assessing officer or the department is telling that no, you are carrying on business, it is not charitable activity, then the provisions would ipso facto apply on the charitable trust. And then I need to fight it out. And then I need to give my audit report. But not in this scenario. There is no specific provision as such as of today in the Act in 11, 12, 13, as we saw the provisions mandating the charitable trust to carry out an audit.
I'll ask the next question, sir, before we move on, which is regarding the to Naveen sir itself.
Yeah.
For the cases where the income is less than 50 lakh and if they are either proprietor, we were providing all the personal assets details also. I mean, that was a practice which was happening. Currently, only more than 50 lakh rupees, the assets has to be declared. So what happens if I declare only the business related bank accounts and we don't declare the personal assets?
Yeah, it's a very interesting question. Now, if you see the ITR, sir, point number 1, this 50 lakhs income, total income is more than 50 lakhs. It would apply only to an individual or HUF. Point number 2, in the ITR, if I see, there are only 10 types of assets. Only 10 types of assets are there, like your immobile asset, bank balance, shares and securities, insurance policies, loans and advances, cash in hand, jewelry, bullion, etc. Mind the word etc. Again, paintings, artwork, etc. Vehicles, boats, etc. Interest in assets of firm, AOP, wherever you are a partner, that's all, total. Then very interesting is less liabilities relating to the above assets. And law is telling, the written is telling, liabilities relating to the above assets. Therefore, only 10 types of assets. So point number 1 is, how do I declare? I am carrying on a business. I'll take a scenario. I am not declaring income on presumptive basis. I am declaring only under regular business. Okay, not presumptive basis. Only 10 types of assets apart from whatever I declared in my business balance sheet, I can declare. What suppose, I have got some watches I want to declare. I want to declare some, luxury pens. I mean, costly pens are there. I want to declare my sofa set. I want to declare my washing machine. I want to declare my, so many other assets are there, personal assets. So therefore, how do I declare when there are only 10 types of assets? Then secondly, suppose, I took a watch and I took a loan to buy that watch. Luxurious watch is there. That luxury watch, it is not there in the 10 assets at all. And law is telling, this written is telling rather, liabilities relating to the above assets. So loan taken to buy that watch, I cannot declare. There is no watch column. There is no liability column. Therefore, what you have to do is, now I want to come out clean. I want to declare all the assets and liabilities. Jewelry, bullion, etc. is there. Painting, artworks, etc. is there. Vehicle, boats, etc. is there. Probably, you can take a chance, go there, because any number of entries you can make. You write there clearly under jewelry, bullion itself, come down and write clearly watch. I am declaring here. Even in that liabilities relating to above assets, touch that and then you write it down there. It's a way to declare. So many assets I cannot declare. It is a must to declare, sir. Otherwise, how to declare. Suppose there is a search or survey. He will ask, how did you declare? Whether it is mandatory, only 50 lakhs I should declare, or even without 50 lakhs income I can declare. Yes, you can declare. And please don't be under the misconception that it's applicable only for a person who is carrying on business. Even a salaried employee is having 75 lakhs income, or a person is having only house property income, or only other source income. You should mandatorily, individual or HUF, total income more than 50 lakhs. Please declare that all the assets and liabilities. Second scenario is 44AD cases. 44AD, only 4 columns you have to declare: sundry creditors, stock in trade, sundry debtors, cash balance. Even there, my dear friends, more than 50 lakhs, you can declare all these things. So these are the pitfalls. Anyway, we have to advise the government, you add some other liabilities column, and please add one other assets, that's all. If you add the word other assets in the column, we are happy. KSCAA has been doing a fantastic job. They are giving representation all over. Probably this can part form of your representation, etc. Thank you very much.
Yes, sir. I'll move to Shiv Shankar, sir. Naveen, sir, for one more round of questions, I hope you can make time. Or Naveen, sir has to excuse 10 minutes more if you are.
Go ahead, Pramod.
Yeah, please go ahead, sir.
Shiv Shankar, sir, there was a clause 2B of KSCAA 2010 requires the auditor to report whether the stock statement submitted to the bank is in agreement with the books of accounts. But there are some reasons which are genuine where they don't match with the books of accounts. How do you handle such situations in the KSCAA at the reporting side?
The difference on account of whatever the difference what you submit to bank and what is the financial statement, there are many reasons. Some of are very good reasons and genuine reasons, and most of the cases it is genuine reasons. See, the difference can happen on account of two things: on account of quantity, on account of valuation. Okay, so on account of quantity, if we are there, so where books of accounts and my whatever I have submitted to bank account, so to that extent we can comfortably say that so there is a valuation difference, because AS2 requires me to do the valuation cost or net realizable value. When they have given the statements, they wouldn't have seen the net realizable value. So there is a methodology in which we prepare the financial statements and the stock statement given to the bankers. So to avoid any of these confusions, so once you are already, most of the things are completed and you already freeze the stock valuation, we advise our clients to go and resubmit once again this stock statement to the bank and give the acknowledgement. Based on that, we are going to rely on our report, because there is no one report we should relay. So they can modify. I will see last report what they have submitted versus my financial statement, and I say that it is in agreement with the books of accounts. Okay, so it is, we can give many other answers, but the simplest answer is, practical answer is, ask them to go and submit the revised one after incorporating everything: quantity difference, quality difference, provisions, everything you incorporate, and go and submit and take the acknowledgement. Based on that, you report. If they are not willing, so then you say that subject to reconciliation. So it is matching. Reconciliation on account of obsolescence, or so valuation, or whatever the reason. Subject to this, it is matching.
Thank you for that. The questions are raining, sir. There are many questions even at the Q&A section. Some of them, if you can answer me.
Yeah, so I am answering some of the things.
Yeah, the Q&A section, sir. Chat, you're answering. Yeah.
Okay, Q&A section. Okay, I will try.
Yeah, Badri sir, we come to the next question, which is on the registered taxpayer has delayed to file the GSTR 3B for the financial year 2021, and a show cause was issued, and an approximately an interest amount of 30,000 of CGST and SGST was levied. As assessee did not pay the amount within 30 days, the demand was passed with a penalty of 10,000 each for CGST and SGST for every month. The penalty now is 2,40,000. Is the officer right penalty on a monthly basis?
For the entire year of 2021, 3B was not filed.
Yes, sir.
Okay, an SCN was issued for the interest of 30,000 as the SC did not pay the amount within 30 days. Okay, so now if the see, there are two things here. One is, as once you receive the order, you have the opportunity to file the returns within 30 days and kind of ratify all the non-compliances. as long as the proceedings were initiated under that section, which is non-filing of returns. Nonetheless, as you said, they've issued a notice and they've issued an order also levying penalty.
Yes, sir.
Is that right? Did I understand
yeah,
the question right?
No, sir. Since he did not pay within 30 days, the demand order was passed with a penalty of 10,000 for each SGST, CGST.
Okay.
And 2,40,000. Yeah.
Understood. Just one second. I'll just show you. I don't know if I can show right.
You want me to pass on the co-host, right, sir?
No, that's okay. Maybe I'll share it separately. You can send it. There's basically you need to look at it in terms of under which provision has the proceedings been initiated. Okay. There are two provisions under GST law. One is 73, the other is 74. 73 is what? It's a normal assessment, normal show cause notice proceedings. 74 is where there is fraud, willful misrepresentation with an intent to evade tax, etc. In those cases, rather in both these cases, till the assessment year, not assessment year, till the financial year 24-25, the penalties are different under both these sections. It said as long as it's under 73, if the interest was paid before the issuance of show cause notice or within 30 days from the date of show cause notice, penalty is zero. Having said that, if it is paid beyond that, then it is 10% of the tax or 10,000 rupees, which is the penalty amount. That is the fixed amount. Okay, fixed amount. It is not per day or something. Similarly, if it is 74, then if it is before show cause notice, 15% mandatory penalty. 30 days from the date of show cause notice, 25%. 30 days from the date of order in original, it is 50%. Anytime thereafter, it is 100% mandatory penalty. Now there is a new section 128A which has got introduced in this budget. It says till 2021. First 4 years, 17, 18, 18, 19, 19, 20, 20, 21. First 4 years of GST. If the order is under 73, as long as the tax is paid, interest and penalty is waived. So specific to this question, if the tax and interest, rather in returns were not filed, therefore I assume tax also was not filed. There was some tax which was not filed, or was it a nil return? I didn't get your question. Sorry, I'm not too sure.
The question is not clear on whether it is nil return.
Okay, if it is nil return, then there is nothing to worry. You can avail the 128A, the new section 128A, no interest, no penalty, no further liability to be paid. If there was a tax liability, then make sure you pay the tax liability before 31/3/25. Then there is no interest, no penalty. Everything is waived, as long as the order is under 73. If it is under 74, then it is 100% of the tax amount will be the penalty amount in addition to interest and tax. No excuse there.
Yeah, thank you, Badri sir. Badri sir, I hope you can stay back. I think there are a lot of questions which are there. If you have 5-10 minutes.
Sure.
Never expected the 19 questions on the Q&A.
Sure.
Yeah.
Should I answer it on the chat also?
Yes, sir. If they are related to GST.
Sure, I'll take a look.
For 19 questions, I don't think I'll be able to take it up in the next 5-10 minutes. Yeah. Naveen sir, the which is on, please give clarity on citing the provisions of the Act and also the settled case. Okay, not this. A breakup of expenditure under GST.
No, that's okay. That is class 44. What I can take, this one, I saw this in chat box. That throw some light on 148 and 148A.
Yeah, okay.
If you notice, that is the latest, this one.
Yeah.
Please recognize that there are today around 36 judgments in our favor. All of you, wherever you have received notices under 148, before that 148AD, before that 148AB, understand these three notices, 148AB, 140 show cause notice under 148AB, then order under 148AD, then it is followed by notice under 148. All these three, my dear friends, should be issued by whom? What is happening now? Department is following 148 ABCD, issuing 148, then transferring to the faceless assessment. So there are 36 judgments which are saying, no, you are wrong. That 148, 148AB, 148AD has to be issued only by the faceless assessing officer, not by the jurisdictional assessing officer. Please take all this technical ground in all your appeals, put it the first ground of appeal now. Let him pass, don't object. When this fellow is passing, for heaven's sake, don't write and don't object. Let him pass 148AD, let him pass 148AB, let him pass, issue 148. Then you go and file a writ petition. Please file a writ petition. It would be quashed. Your notice shoot will be quashed. Latest judgment I am giving you, High Court of Bombay, delivered on 3rd of September, just 10 days back. Delivered on 3rd of September, High Court of Bombay, 166 taxman.com, 284. Simple. What is it telling? What is the Honorable Bombay High Court telling? Assessee has challenged the notice issued under 148AB as well as 148. Don't think it is only for 148, sir. This is for 148, 148AB, 148AD. So no need to get confused. Please file a writ. It was found that the impugned notice issued under 148AB, order passed thereon under section 148AD. Consequent notice issued on 148 were all issued by the JAO and not by faceless assessing officer, as is required by provisions of 151A of the Act. Whether since the revenue had not complied with the scheme notified by central government pursuant to 151A subsection 2, notice issued under 148 was to be quashed. Para 4 and 6 in favor of the assessee. Very simple, sir. Please fight it out in this. You'll have to recognize 151 subsection A, and then the scheme which is notified by the central government pursuant to 151 subsection A, 151A subsection 2. Scheme has been tabled in the parliament. It is in the character of subordinate legislation which governs the conduct of proceedings under section 148A. Sir, the case name is, I'll tell you the case name. Again, one query has come in the High Court of Bombay, McLeod's Pharmaceuticals Limited. Please note down, sir. McLeod's Pharmaceuticals Limited versus ACIT, High Court of Bombay. In turn, it is relying on Hexaware. I have 35 more judgments. Do not worry, but don't please, for heaven's sake, you inform the assessing officer at the time of, issue of show cause notice on 148AB. Please be quiet. Let him pass 148AB, 148AD, then issue 148. Then you can go and file a writ petition. Your notice will be quashed. Karnataka High Court also, I think the same issue, there is no judgment as of now. It was, posted for hearing on 13th of September, I think. So I don't know what has happened. Our Karnataka High Court. And 100% I'm sure you are going to get a favorable decision because already 35 judgments are there of all the courts all over India, except Karnataka High Court, which judgment is reserved. I don't know. It was there on 13th. So I don't know what is the outcome actually. So I have given you the, the citation also. I do not want to go into detail. Again, Mr. Pramod was asking about clause 44. So how to distinguish karke, there are 6 columns in the clause 44. I would like to talk for 2 minutes and then end because I'll have to give opportunity to others also. So clause 44, my dear friends, total amount of expenditure incurred during their column 2. Then expenditure, that column 3 is what? 3, 4, 5, 6 will come under one head, expenditure in respect of entities registered under GST. Last column will tell expenditure relating to entities not registered under GST. So first one is okay, serial number 1, etc. No problem. Total amount of expenditure incurred during the year. You'll have to pick it up from your P&L account. It may be from the balance sheet also, like prepaid expenses, etc. Don't think it's only from the P&L account. What should not be put in column 2? For heaven's sake, items which are not supply under GST are also not required to be reported in column 2, like depreciation, bad debts, your salary, remuneration, your stock, etc., forex gain, loss, etc. Then column 3, what should you report, sir? Relating to goods and services exempt from GST. You can report all these exempted, nil-rated, non-taxable supplies like your liquor, petrol, natural gas, electricity, interest charged by bank, interest on loan, etc. If the lender has GST, then what about column 4? Very simple, sir. All your entities falling under composition scheme are to be reported. You'll have to see your invoice. What is column 5? Relating to other registered entities. So here you can refer to, all the inward supplies from the registered dealers, other than supplies from composition dealers and exempt supply, because it's taken care in other columns. From registered dealers are to be mentioned here. Column 6 is, the total of column 3, 4, 5. In any case, now the column 7, last column, it is relating to entities not registered under GST. For example, import of all goods and services, the expenses on which RCM has been paid, your customs duty, your late fee, your interest on loan. That is, if the lender does not have a GSTIN, and all other non-GST registered entities expenditure. Another 1 minute, sir, before I just sign off. Lot of questions are being asked on bogus purchases. Do not worry, sir. That is the latest flavor of the season. There are 4 or 5 orders I have seen. 4 or 5 orders, different stands taken by assessing officer. So how to argue on these bogus purchases? Point number 1 is, there are plethora of judgments where they are telling have you only disputed my purchases? You have not disputed my sales. If you are telling me my purchases are bogus, I have made sales. I am telling bogus purchases. What I am telling is my genuine purchases. It is entered my stock records and I have made sale. But the department, the assessing officer, not disputed the sales. Then how can you add only bogus purchases? You have not disputed the sales. Point number 1 is you have not rejected books of account, but you made addition of bogus purchases. Point number 2, you have made addition of bogus purchases without disputing my sales. So without bogus purchases, without purchases, alleged, so-called alleged bogus purchases, how can there be a stock and how can I sell? And you are not disputing my sales. Therefore, there are innumerable judgments, sir. They are telling, if you are not disputing the sales, what can you tax is only element of net profit or gross profit, which is embedded in the purchases. Do not worry. Thirdly, they are telling, you are making addition of bogus purchases on some third-party information, like you are receiving information from the GST department, etc., or from your AIS information. This basically all this information, but you cannot make an addition without sharing the same with the assessee. You cannot make a addition at the back of the assessee. You please share it with him, give him an opportunity of being heard, take his arguments into account. So all these are various ways and means to tackle bogus purchases. Fifthly, if the assessing officer has himself taken only gross profit and made addition, then please go ahead under VSVS. Go ahead. It is a very reasonable 10%, 5%, 6%, etc. If he has made addition, then please go to VSVS and declare that and pay the tax. When himself he has taken 6%, 8%, etc., reasonable GP, one assessing officer, last 30 seconds, one assessing officer made an addition for the undisclosed capital for the rotation of bogus purchases. He told, what is the capital? You have done bogus purchases. So for that, there should be some capital. So he took that and he made a ratio there. He added the GP. He also added the capital. So there you'll have to probably dispute that capital and accept the GP at least, or we need to, try to, based on the facts and circumstances of the case, either accept both or fight both. Thank you, sir. Thank you very much for giving me an opportunity.
Yeah. Badri sir, we have a question which is on...
just one thing, Pramod. Yeah. Just to add to what Naveen was mentioning on this bogus purchases, there's a circular of 22 as well, which says, as far as GST is concerned, if as long as it's only a bogus purchase and consequently a bogus sale also, as far as GST is concerned, there is no loss to the revenue. It is a revenue neutral transaction. Therefore, government has issued a circular there which said, look, we don't want the because what would have naturally happened in this case is that person on an incorrect transaction, he would have taken the ITC and you would have discharged the output tax also. So very technically, rather arithmetically speaking, government has received an element of GST on the profit, which, if you see, it was not really required to receive. So government said, look, don't worry about output tax and input tax. We are not going to challenge them. Not even challenge the ground that, look, you issued an invoice without supplying the goods, therefore penalty, therefore output tax. But as far as input tax is concerned, you wouldn't have received the goods, but you've taken the input tax credit. Therefore, we are not going to challenge the input tax credit also. Only thing government was worried about is penalty, which unfortunately in such transactions is 100% of the tax and twice. One, to have claimed the credit without receiving the goods. Second is to have issued the invoice without actually supplying the goods. So I'm actually, facing a penalty of 200% of the tax amount. Just be careful about that.
So there is a question which is on, which I will read it for you, sir. We have seen in few AARs, which says cutting tree in forest area for sale is taxable service as agricultural produce is not justified for forest produce. However, in case entities involved in tree planting as a part of tea or coffee plantations grow and cut the trees, will this activity of cutting such tree will also be taxable?
See, it is like, the taxability really comes into play in GST only when you supply. Like we have section 7, 7 and 9, the charging section. There shall be levied a tax hereinafter called the central goods and service tax on all intrastate supply of goods or services or both. So basically there has to be a supply and there has to be a consideration attached to it if it is an unrelated person. Only then the question of taxability triggers under GST. Now mere cutting doesn't trigger a GST liability. It has to be supplied. Am I selling the wood that is coming out of that? Then yes, it will be taxable.
Okay. Fine, sir. Shiv Shankar, sir.
To the extent I could read, I've answered one or two questions on the chat, Pramod.
Yeah. I mean, I've been getting requests to continue this, sir. So I am presuming 5-10 minutes we'll continue and then try to answer as much and then we'll cut it, sir. Yeah, Shiv Shankar, sir,
Yes.
there are a few questions in the Q&A.
Hmm.
I will read out which is on SRS 4410 or compilation engagement. Is there an apparent mistake in the books of accounts? Should the auditor report anything in his report issued under compilation engagement or restrict himself for just compiling the statement without exercising discretion?
The compilation engagements are just to compile the financial statement based on the books of accounts. Okay, so yes, definitely to the extent of compared to audit or limited review, so the engagement, the scope is much limited. The only thing what we have to see whether the compiled financial statements is agreement with the books of accounts. Number two, the same accounting auditing practices or auditing standard or accounting principles which they were applied earlier, the same is applied here also, like valuation of inventories. We can't just take it based on the face value. So whether inventory earlier what we have done is FIFO method, now in compilation they have done on weighted average method. That is not allowed. So definitely accounting standard compliance and our accounting policy compliance required to be seen, and whether it should be in line with the books of accounts. And there is a compilation report which auditing standard prescribes. What is my responsibility? What is the client's responsibility? It is mentioned everything. You give the compilation report based on that. Don't sign just balance sheet without giving the report. So I have seen some financial, for projection or compilation, they will ask bankers, they will ask something. So they will sign the financial statements or provisional financial statement or compiled financial statement without audit report. It is required to be mentioned very clearly. Audit report required to be given. So that they will not say auditor's report, it is an accountant's report.
Sir, there is one follow-up question which we earlier answered. Is actuarial valuation required for a company with fewer than 50 employees if some employees have been on payroll for more than 5 years?
See, if Gratuity Act is applicable, then actual valuation is applicable. Assuming my employees is less than 10, so then not required to enroll. See, even then, even if Gratuity Act is not applicable, then there is no liability. When there is no liability, valuation does not arise. So when there is a liability, valuation will come into picture. So even one day, if it is exceed 10 and then it comes back to 2, so still I need to do the valuation as per accounting standard. Otherwise, it is a non-compliance of accounting standards.
Any closing remark you want to give, sir? You have anything in general to give? I know there are many questions which we could not answer. I'm sure.
Yeah. So as far as this Companies Act things are concerned, so go day by day, it is getting complicated. Like see the audit trails and other things. I would suggest not to make any mistakes in giving the factual reporting. If it is there, you say yes. If it is not there, say it is not there. Nothing will happen. Nobody will take any penal action. Even if they take it, it is very meager. For small things, let us not overprotect our client, go overboard and give some. Wherever there is an opinion, yes, there is a matter of professional judgment. You can take the management representation, do the adequate documentation, and give to the extent possible. So many times, whether it is a qualification or emphasis of matter, if you feel that management is not agreeing for qualification, they are okay with the emphasis of matter, that is more than sufficient. Somewhere you have mentioned something. Okay, so as a auditors, we know what is emphasis of matter or what is a qualification. The person who is using the financial statement, he knows that there is some comment. That is more than sufficient to protect us in future. So don't go over the board and help anybody and report factually wrong. Reporting should not be done. So that is what is my concern. Thank you very much.
While still you staying on, sir, Badri sir, you have any closing remarks on the GST?
Maybe I'll just add to what Shiv Shankar sir was mentioning. I'll just add to what he was mentioning. It is and maybe what Naveen also was telling. I have to protect myself first, then the client, right? It is in the same language which Mr. Shiv Shankar also just mentioned. it's like, always remember there is one section called 122(3) in CGST Act. It says any person who aids or abets any offense specified in 1 to 12 of subsection 1 is also liable to penalty. That can go on to include the auditors as well. Okay, so it is not about protecting someone at the cost of ourselves. It is not about that. It is more in terms of how correctly are the transactions being reflected, being explained. That is the most important. See, because a lot of these questions come up only when we have these financials to be finalized, the income tax returns to be done. Please keep in mind one aspect. There was a question which was there in the chat box also, which and it is about that bogus purchase or sales. What we have to keep in mind is GST is part of every day. We can't run away from that. All right. So you should be sensitive to what you're doing on a daily basis and not just wake up and think about all this when you have to file your income tax returns or do your financials. I'm sorry. Why I'm saying this is because there are a few aspects where I've worked very closely on some of the aspects of the government. Don't underestimate what the kind of data government has. Okay, don't underestimate. Please assume, even if you want to assume, then assume that government has more information about you than what you have about yourself. That's a good assumption to make. Okay, please, the technology, the analytics, government is using very efficiently, I should say. And so please don't underestimate. And let's be transparent in what is happening. I think it is fine. Thank you.
Yeah, thank you, Badri sir and Shiv Shankar and Naveen sir in his absentia. I have to thank him as well. I'm sure this session should have run a little more longer, but then I have taken only time till 6 p.m. while I continue till 6:20 without seeking much of their permission. There are many questions to answer. If you feel that your questions were not answered, I am not the person to ask. You should ask the President KSCAA for him to repeat this session once again. And of course, this is an immense value to our members because even if around 30-40 questions we were able to answer, and if you are to put it in value terms, I mean, it's a huge value which you receive. I'm sure associations will do such similar programs which are very relevant to members, and they will come up with a second version of the same. With this, I thank both say Badrinath sir for taking his time out, coming. In spite, I know that he was with the doctor or he had his own emergencies, but still he made up. And Shiv Shankar sir and absentia of Ravi Prasad, who could again not join because due to some emergencies. And also thanking Naveen Khariwal. Also thank KSCAA for providing me an opportunity to moderate these. It's a wonderful panel. Thank you.
Thank you. Thanks for this opportunity.
Thank you, Pramod.
Wonderful event. Thank you.